Welcome to Manhattan 5, Friday, 21st August 2026. Here are the 5 developments that matter. Number 1. The bond market just rejected the rescue. The Treasury doubled planned buybacks of older long-dated bonds to at least use $4 billion per operation, but the relief lasted about 1 day. The 10-year yield rebounded above 4.70%, while the 30-year returned around 5.26%. Equities followed lower. Treasury can buy bonds, but it cannot erase inflation and fiscal risk. Higher funding costs raise hurdle rates for property, equities, and long-duration infrastructure. The Manhattan view: the bond market refused to remain rescued. Number 2. Gold is becoming the confidence trade. Gold reached approximately $4,137 an ounce, its highest level since early June, and is up about 3.6% this week. It is rising despite high bond yields, signaling demand for protection against dollar debasement, expanding sovereign debt, inflation, and geopolitical risk. The Manhattan view: gold is becoming a confidence hedge, benefiting whether governments suppress yields or allow them to rise. Number 3. The AI build-out is moving off balance sheet. Broadcom is reportedly exploring more than $60 billion, potentially up to $100 billion in senior and junior debt for AI chip and compute infrastructure supporting OpenAI and Anthropic. A special purpose vehicle could bring in private capital. That shifts risk from technology companies toward lenders, funds, and institutional portfolios. The Manhattan view: private credit is becoming the balance sheet underneath AI. Underwriting must test guarantees, residual hardware value, and usage assumptions. Number 4. Oil is becoming an inflation tax again. Brent is around as 93.55, up more than 7% this week. WTI is around $86.50, up more than 8%. Shipping through the Strait of Hormuz has reportedly been cut roughly in half amid the US-Iran conflict. Higher oil feeds inflation, consumer pressure, margins, and interest rate policy. If oil stays above $90, the Fed has less room to ease even as growth weakens. The Manhattan view: oil links geopolitics directly to interest rates. Number 5. Crypto is trading the money, not the economy. Bitcoin jumped about 5% in the latest session and is up roughly 15% this week, even as equities weakened and yields rose. The dollar reached a 3-month low after expanded Treasury buybacks. Bitcoin and gold are expressing concern that governments may intervene to contain debt costs. The Manhattan view: the macro foundation is real, but speculation can still create an overshoot. Watch whether crypto holds its gains if the dollar stabilizes and yields remain above 4.70%. The Manhattan bottom line: these stories are one story. Governments are trying to control the cost of money while war, debt, and AI infrastructure increase demand for it. Treasury support met bond resistance, oil added inflation, gold and Bitcoin priced monetary distrust, and private credit financed what public balance sheets cannot comfortably fund. This is not yet a systemic break, but the price of capital is again